your savings account is lying to you. Not with bold-faced dishonesty. Just quietly. Slowly. Every single month, the number on your screen stays the same or creeps up a little while the actual value of that money shrinks. That is not saving. That is losing money in slow motion. Right now, in June 2026, there is a window. A closing window. The Bank of England is cutting rates. Energy bills are coming back up in July. And inflation, the real number, not the official one, is heading somewhere most people are not prepared for. In the next 10 minutes I am going to show you exactly where your money should be sitting right now, and the specific moves you can make before July that could protect hundreds, possibly thousands, of pounds this year. Most people think lower interest rates are good news. Your mortgage might get cheaper. Borrowing gets easier. Sounds fine. What they do not tell you is what lower rates do to your savings. The Bank of England held rates at 3.75% in April. Markets are pricing in further cuts before the end of 2026. That sounds abstract, until you realize what it means for your ISA, your easy access account, your premium bonds. Savings rates follow the bank rate. When the bank cuts, providers cut, usually fast, usually quietly, and usually before you notice. The best fixed-rate bonds and cash ISAs available in June 2026 are almost certainly the best you will see for the next 12 to 18 months. The window to lock those rates in is right now. Not next month. Not after you see what happens in July. Now. In April, your energy bill dropped by 7%. Most households saw that as relief. A sign things are getting better. It was not a sign. It was a gap. Because of what is happening in the Middle East right now, global gas prices have been rising steadily since March. Analysts at Cornwall Insight and the energy regulator both flagged it. The October price cap, which is set using data from the coming weeks, is already looking significantly higher. Your energy bill in October is almost certainly going up. Maybe 10%. Maybe more. And that feeds directly into the inflation figure that everyone thought was under control. The IMF already cut the UK growth forecast to 0.8%. That is the worst downgrade of any G7 country. Not recession by the textbook definition, but stagflation, slow growth, sticky inflation, which for most households is actually harder to manage. The point is this: the official story in June says things are improving. The data says the worst of the inflation cycle may not be behind us. You need to plan for the real numbers, not the comfortable ones. Let me be specific. Because vague financial advice is useless. Fixed-rate cash ISAs. Right now in June 2026, one-year fixed cash ISAs are paying between 4.2 and 4.8% from several UK providers. These rates are protected from future bank rate cuts. If you have money sitting in an easy access account earning 2%, or worse, nothing, this is the exact move. The ISA allowance for 2026 to 27 is £20,000. Tax-free interest. No capital risk. The process takes 20 minutes online. Premium bonds. The prize fund rate is currently 4.4% equivalent. It is variable, which means it will fall when the bank cuts. But for money you might need quickly, it is still a strong option. Notice accounts. If you can live without touching money for 30, 60, or 90 days, notice accounts are currently offering rates close to fixed bonds, with slightly more flexibility. What to avoid? Leaving more than you need in easy access accounts earning under 3%. Leaving any significant sum in a current account earning 0. Leaving your full emergency fund in cash when part of it could be working harder in a 60-day notice account. Here is the uncomfortable calculation. If inflation averages 4% over the next 12 months, which is a realistic scenario, and your savings earn 2%, you are losing 2% of your real purchasing power every single year. On £10,000, that is £200 of real loss. On £50,000, it is £1,000. Silently, automatically, every month. That is not dramatic. There is no bill. Nothing leaves your account. The number stays the same. But what it buys, food, energy, rent, everything, costs more. You are poorer and the screen does not tell you. This is what stagflation does to ordinary savers who are not paying attention. And the window to protect yourself is not infinite. Before July, run this check on your home. First, are you on a fixed energy tariff? If you are on a standard variable tariff, you are fully exposed to the July rise. Check what fixed deals are available now through price comparison sites. A 12-month fix at today's rates may well be cheaper than sitting on the variable cap through winter. Second, have you applied for the warm home discount if you are eligible? Many households who qualify have never applied. It is £350 off your electricity bill. It takes 20 minutes. Third, do a standing charge audit. Many households are paying 20 to 30 pence per day in standing charges they could negotiate or switch away from. Over a year, that is £70 to £110 for doing nothing. These are not big actions. They are 20-minute actions. And they add up. Most people manage their finances reactively. Something changes, a bill arrives, a rate drops, a news headline lands, and then they respond. Usually too late. The people who come out of every inflationary cycle better than they went in do one thing differently. They make the decision in the window before the deadline, not after. The July energy cap rise is a deadline. The bank rate cut cycle is a deadline. The ISA window is a deadline. These are not abstractions. They are specific, datable moments when something changes, and the people who acted before them will be in a fundamentally different position from the people who did not. You have the information now. The question is whether you act on it. Here is your action list for this week. 1. Find out what interest rate your savings are currently earning. Log into your bank. Check the number. If it is under 4% and you have money sitting there you do not need in the next 30 days, move it. 2. Check the energy deals available on your postcode right now. Use Uswitch or compare the market. 10 minutes. If you can fix below the expected October cap, fix. 3. If you have not used your ISA allowance this year, open a fixed cash ISA before rates start dropping. That is it. 3 actions. 45 minutes. Potentially hundreds of pounds protected. Subscribe to Recession Playbook UK. Every video in this channel is one practical step you can take in the real world, not theory, not opinion, just the information you need and the action that follows from it. Share this with someone who has money sitting in a current account earning nothing. They need to hear it.